In a single trading session, the probability of a Federal Reserve rate cut at the next FOMC meeting has fallen 14 percentage points, from 56% to just 42%. With nearly $2 million flowing through this market in 24 hours, this is not noise. Something has shifted in how informed participants are reading the near-term path of monetary policy, and this video examines exactly what. Three distinct signals converged to reshape the market's view of Fed policy. First, the latest inflation print came in at 3.4% against an expectation of 3.1%, a meaningful miss that materially reduces the Federal Reserve's urgency to ease. Second, remarks attributed to Chair Powell ahead of the Jackson Hole preview struck a decidedly hawkish undertone, reinforcing the case for patience over action. And third, two voting members of the FOMC have now gone on public record pushing back against near-term rate reductions. Taken together, the hard data and the official communication are pointing in the same direction. The committee is in no hurry, and the market has absorbed that message. When a prediction market contract moves 14 percentage points in a single session, it reflects a genuine change in collective judgment, not a temporary fluctuation. Participants who held yes contracts at 56 cents, implying they judged a cut to be the most probable outcome, have now marked those contracts down to 42 cents. The market is saying clearly that a pause is more likely than a cut. With $3.15 million in liquidity underpinning these prices, this forecast carries real statistical weight. This is a deep, well-capitalized market, and its readings have historically preceded official outcomes with meaningful accuracy. Beyond the headline probability, the directional flow signal from sophisticated market participants is unambiguous. They are selling the rate cut forecast. In prediction market terms, a sell signal on the yes contract means that the traders with the largest positions and the strongest historical track records are actively moving out of this view. This is not retail sentiment reacting to a news cycle. It is informed capital repositioning in direct response to the same inflation data and Federal Reserve communications that the committee itself is watching, and that alignment between smart money flow and macro fundamentals is historically significant. This is not the first time a single inflation print has forced a rapid recalibration of rate cut expectations. In late 2023, prediction markets had priced in 5 or even 6 reductions for the following year, a view that collapsed within weeks as persistent inflation forced a reassessment. The correction, when it came, was swift and tended to overshoot. The pattern is consistent. When hard data and Federal Reserve communication diverge from the market's optimistic base case, the repricing is rarely a gentle adjustment. Today's 14-point move fits squarely within that historical sequence, and the precedent suggests the adjustment may not yet be fully complete. The probability now stands at 42%, and 3 catalysts will determine its next move. The incoming CPI print is the single most critical near-term data point. Another upside surprise would likely push this forecast below 30% and effectively close the door on a near-term cut. Watch also for the official FOMC minutes, where any internal dissent will appear in the written record, giving markets a more granular read on the committee's true divisions. And monitor any further public communications from Federal Reserve officials in the weeks ahead. To follow this forecast in real time and be the first to know when the next catalyst shifts the market, subscribe to this channel and follow the link in the pinned comment below.